Good morning, good evening, good night, wherever you may be. Thanks for watching, guys. Time for another bit of Canadian housing crisis. We're going to follow up and wrap up what's happening in Canada from coast to coast. Montreal seeing spikes in sales and Vancouver bottoming out a bit. So let's start with the Canadian households. See borrowers' cost rise to highest levels since 2011. So borrowing costs are going up, guys, and that's very important when you're doing some mathematics. You start to realize things start to cost more when you buy them. Not up front, but on the long run. So you end up paying your house off 3 times or 4 times off from the asking. Whatever, you buy a place for $100,000. Price of lending goes up, costs of borrowing goes up, you end up paying $300,000 back in the matter of 10, 20, 30 years, whatever time it takes you to pay it off, right? So let's look at this. Is from August 13. That's from today's date from our friends over at Better Dwelling. Canadian households are facing more difficult time borrowing cash than last year. Numbers from Bank of Canada BOC show the effective weekly borrowing rate reached a 7-year high. Rising interest rates and falling credit demand has sent the rates soaring from last year. The speed of the climb is likely to taper credit demand even further. So that's gonna start to see less spending in the consumer levels. So what's an effective interest rate? The effective household interest rate is a typical rate you will get if you went to a bank for a loan. The Bank of Canada calculates it by using a weighted average of mortgage and consumer loans. These rates are lower than posted rates because it also includes discounted rates. The effective interest rate, sorry guys, these rates are lower than posted rates because it also includes discounted rates. The effective interest rate more accurately reflects on the lending conditions of that households face. Canadian households are borrowing costs to rise over 18%. That is very vigorous. And if you don't know what vigorous means, or VIG, look it up. The cost of borrowing is making steep climbs as lenders try to cool their debt binge to sustainable levels. The weekly effect borrowing rate reached 3.77 points at the end of July, up 18.55% from the last year. In addition to it being the highest level we've seen since May 2011, it's also one of the fastest climbs. We haven't seen this rate climb this quickly since before the Great Recession. Not the Great Depression, but the Great Recession. Canadian households are borrowing rates. Bank of Canada's weekly effective borrowing rate for Canadian households, the number is weighted on average of interest rates and mortgage consumers' credit products. So that's what's going on here. So here we go. Oh, wow, it really is. Slower borrowing, smaller amounts. Considering the speed at which lender rates are climbing, it's going to have a big impact on borrowing. For example, a mortgage borrower at today's effective rate would qualify for 7 points less than one last year. That's assuming the household made roughly the same income, and before stress testing, households face serious loss of leverage, which may be a good thing. It depends on if you make money from households having more leverage or not. So it depends on your down payment. It depends on a lot of things too, right, guys? In addition to lower leverage, rising rates impact existing borrowers and future demand. Existing borrowers face higher servicing costs, lower free cash flow. That's a big loss for consumer industries. I mentioned that earlier. And that depend on long-term financing. Higher servicing costs also tend to lower demand for new credit. This has the counterintuitive effort to tightening credit supply even further. Lower credit demand usually leads stronger venting of borrowers. So guys, is that venting? Vetting of borrowers. Sorry guys, you know I got a grade 6 reading level, but I want to get this message out because it's very important. And that's what's happening on the headline here. I read this one last week. This week's top, a few days ago because we're wrapping up this week. This week's top stories: Toronto and Vancouver detached sales continue to slow while mortgage payments and HELOCs soar. HELOCs to me are second mortgages, but someone told me in the comment section that they're a line of credit that you could activate from your house. To me, it's a second mortgage. It's on your property. It's a lien. It's a second lien. So I mean, okay, it's an adjustable line of credit that goes from prime plus whatever, plus 1, plus 2, right? So we went over this. Canadian rate, the average mortgage HELOC payment is soaring in Toronto and Vancouver. And mortgage delinquencies are flatlining across Toronto and Vancouver, so shows CMHC data. Canadians held on to more cash, so let's move on. The average mortgage and HELOC payment is soaring in Toronto and Vancouver. I already read this the other day again. Canadians' real estate buying spree may be over. The buying off the debt has barely begun. The Canadian Mortgage and Housing Corporation, CMHC, the Crown Corporation in charge of the housing research, teamed up with Equifax to crunch the numbers on the average payment due. Larger debt loads and higher interest rates pushed the average monthly payment for housing much higher in Q1 2018. The large increases are just beginning as interest rates continue to push towards normalization. So you can see today in today's stock market, everything is going down. Everything is plummeting right now, actually. I checked my portfolio. I'm like, oh my God! Well, you know what? You got to take a hit once in a while, right? Average mortgage payments soared. The average mortgage payments is rising quickly in Toronto and Vancouver. Vancouver homeowners had the average of payment of $1,794 per month at the to end up Q1 of 2018, up 6.53% from the previous quarter. The average in Toronto reached $1,662 in Q1, up 6.4% from the last quarter. In Montreal, the average payment reached $1,060. Mind you, it's a lot more affordable. Q1, 2.51%. I'm looking for Q4 to see where Montreal hits. Baby boomers are back in the housing market, and it will impact prices, says Royal LePage. So, don't know how much of this we could believe, but more than 1.4 million Canadians between the ages of 54 and 72 expect to buy a house in the next 5 years, according to the new survey by real estate powerhouse Royal LePage. Boomers will either be downsizing to small properties in their hometowns or looking for greener and cheaper pastures away from the big cities, the research shows. Either way, this is expected to have a meaningful impact on the housing market, report reads. Canada's housing market has already been through a boom, bust, and echo, said Royal LePage. Oh, so it's over? Okay. Quoting the 1990s bestseller book Boom, Bust, and Echo, the Canadian demographer David Foote. The boom happened when the boomers entered the market the first time. Home ownership then upgraded to larger homes a few years later. Then bust had in a part where to do with smaller numbers and Gen X home buyers. The echo kicked in with when millennials and children boomers started looking for a home of their own, Soper said. So this is before the big, I guess, increases that happened in the last 2 years. Now, we may be in another real estate market commotion caused by boomers as Canadians are approaching retirement, look for better homes suited for life after work. So guys, the great Canadian blame game. Boomers, millennials, Gen X's, the government, foreign investors, foreign buyers, boomers taking second mortgages on their equity of their homes they had free and clear to buy more real estate, parents buying homes and apartments for their 3-year-old kids so they could afford to buy, or they don't have to worry about buying when they get older. What is going on? Who is the great Canadian blame game? Who do we blame for this? Do we blame the record low interest rates that are blowing in hot air into this market? It is really good, really, 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 really good. And that's why talking about housing and the markets is so much fun. Warning, signs of global economic chaos could spread to Canada. Oof. Canada's latest job creation numbers out at the end of last week are astounding. The recent figure shows the country's economic growth and annual rate of 2.6% were better than almost anyone expected. So this is... So we're going to move up down here. Contagion triggered. So let's find out what this contagion is. In Canada, the unemployment rate fell back to its recent low of 5.8%, measured as a percentage of population. Canada's employment rate and participation rate exceeds that of the U.S. It's 350 million to 35 million. So, I mean, in normal times, you would expect such an economic signal would drive the loonie higher. Instead, a few hours after job results, Canadian dollar was down nearly half a cent. The loonie failed to gain momentum from the economic indicator released given the current geopolitical climate. Alfonso Espressa, an analyst at the currency trading company Onada, said in an email. And Canada was not the only country affected by the turmoil in the world. The Turkish lira has been in free fall and has triggered contagion fears as Spain, Italy, France have high exposures. Before the Asian crisis in 1997, many analysts talked about the divergence, shorthand from the idea that the developed world, especially the US, would remain unaffected by contagion from the less developed South. In fact, Asian currency meltdown of a time unfolded. There was early evidence that the supporters of divergence have been right. So there's good old Trump. Spreading disease. On Friday, shares in European banks with Turkish exposure tumbled. So did currencies of the other developing countries, including South Africa and Argentina. Oh yeah, Argentina is going to face that thing they did back in the 80s, late 80s or early 90s. I can't remember when, but yeah. Once again, the flight to safety has begun to push the U.S. currency up as global investors sell developing countries' assets and buy those demonetized in the U.S. dollar. The rising U.S. dollar is likely the main thing keeping the loonie down. So Canada's got to start pulling up its socks and looking sharp and creating. Canada needs to create 800,000 private sector jobs, not government. Government jobs mean nothing. So when there's government job layoffs, nobody is really crying about it because it's our tax money anyway, so it doesn't really, it's actually better. But when it's private sector jobs that get lost, and those taxable jobs and taxable income and income taxes, and that's what the government's hoping, that more people will invest in the private sector jobs, invest in private sector opportunity. But that is not happening right now here in Canada. Canada's home sales touch 5-year low for June, 10% since last year. So home sales are down. Canadian housing activity appears to be climbing out of its slump, but it's still far from a rebound. Canada's Real Estate Association said on Monday sales in June were up 4.1% compared with May, marking what a board described as the first substantive month-over-month increase year. However, the June sales were down 10.7% compared with a year ago, a 5-year low for the month. So guys, pay attention, guys. It's very important. You're going to get a lot of real estate companies and organizations tell you that the housing market is rebounding and is doing well, and it's a good time to buy. So be careful, guys. Montreal's hot real estate market spawns rare phenomena. Bidding wars. Bidding wars are here in Montreal. Bidding wars in Montreal, baby. It's never happened before. Oh, man. I'm going to save this article for another story, guys. I'm going to do another story later because I want to focus on this and get people from Montreal on my channel. You know, hopefully they can understand what I'm saying because the majority of them speak French. But anyways, that's the headline. Montreal's hot real estate market spawns rare phenomena. Bidding wars are coming there. Then they're going to kick off rental wars. They're going to kick off everything. Guys, appreciate you guys spending time with me and going over some housing analysis here with Mike Martin's Mike Martin's here, housing guru. The stock markets are going to be closing. I'm keeping an eye on my portfolio. I'm down, I think, 6% now. In one day, so that's a pretty huge percentage loss. So I'm keeping an eye on it. Nothing to fear too much over about. But guys, keep an eye on your portfolios, guys. If you have a portfolio, oh look, I sold something on eBay. Comment below. Thanks for watching, guys, and enjoy the rest of your day.